Your parents bought their home in 1981 for $85,000. Today, that home is worth $620,000. If they sold it before they passed away, the capital gain would be $535,000. A portion of that would be taxable. But if you inherited that home and then sold it, your taxable gain is not $535,000. It is zero. Here is why. When you inherit property, the IRS resets its cost basis to the fair market value on the date the previous owner passed away. This rule is called a stepped-up basis. It is written into Section 1014 of the Internal Revenue Code. What it means in practice, every dollar of capital gains that accumulated during your parents' lifetime, 10 years, 30 years, 40 years of appreciation, is permanently erased the moment the property transfers to you. The IRS does not tax gains that occurred before you owned the asset. Let me make that concrete. Your parents bought in 1981 for $85,000. The home is worth $620,000 when they pass away. Your basis as the heir is $620,000, not $85,000. You sell the home 6 months later for $635,000. Our taxable gain is $15,000. The difference between what you sold it for and the stepped-up basis on the date of death. Not $550,000, not $535,000, $15,000. In 2025 alone, approximately 340,000 homes were transferred through inheritance in the United States, a record high. The majority of those families either did not know this rule existed or did not know how to apply it correctly. Here is where most families make a costly mistake. They assume that because the gain is erased, the $250,000 Section 121 exclusion also applies, and that the inherited home is therefore completely tax-free no matter what. That is not accurate. The Section 121 exclusion sees the rule that eliminates up to $250,000 or $500,000 in capital gains on a home sale requires you to have owned and lived in the home as your primary residence for at least 2 of the 5 years before the sale. If you inherited the home and sold it without living in it for 2 years, Section 121 does not apply. What protects you is the stepped-up basis alone, which means your gain is calculated from the date of death value, not the original purchase price. If the home appreciated significantly after you inherited it and you did not live in it, that post-inheritance gain is taxable. To know exactly where you stand, you need one document: a qualified appraisal of the property's fair market value on the date your family member passed away. That number is your basis. Everything above it, at the time of sale, is your gain. If you have inherited a home, or if you expect to, do one thing. Get a qualified appraisal dated as close to the date of death as possible. Not an estimate, not a Zillow number. A formal appraisal by a licensed appraiser, documented and on file. That document establishes your stepped-up basis. It is the single piece of paper that determines whether your tax bill on the sale is $0 or tens of thousands of dollars. If the estate has already been settled and no appraisal was done at the time of death, a retroactive appraisal may still be possible depending on available records and how much time has passed. A tax professional or estate attorney can advise on whether that option is available in your specific situation. Subscribe and turn on notifications. I will see you there.